NVIDIA. You can see that they're at 119. This is the Trident on NVIDIA currently. So we are at the very bottom of the buy zone right now. I really like this in the 90s. If I see NVIDIA in the 90s, I want to basically load up, go to my savings account, load up on NVIDIA and buy some there. That don't mean that you got to do it. You got to have a plan. However, with what I'm looking at this week, I'll be willing to put some money in, not too crazy, at about 118. That would be preferable. The max I'm willing to pay for a long-term hold, though, is 124, but I'm really looking for that.
If you've got more than $10,000 in the bank and you're thinking about investing in e-commerce or trucking automation just to get a measly 5 to 7% annual return, I have something exciting to share with you. There's a smarter, more profitable way to put your money to work. Let's talk about ATN. ATN is automated trading network, and it isn't your typical investment platform. We're a private community with exclusive access to some of the world's leading trading platforms. Our gold members are securing monthly returns of 10 to 14%, and our diamond members are doing even better. Those returns significantly surpass ROI typically seen with stocks or real estate. So how do we make this possible? My team and I partner with people like you who have at least $10,000 saved. We confirm all of your goals and expectations, and if it makes sense on both sides, we then provide access to these exclusive trading platforms. We're your silent partners, helping to turn your savings into significant returns while you live your life. You might wonder why we don't just do this for ourselves, but the truth is we do. Here's a look at my personal account. As you can see, I'm earning over $24,000 per month, and it takes less than 1 hour per week to manage. We thrive on helping our partners achieve financial freedom and success, and we only partner with a diverse group of individuals to provide personalized attention. Now, if you're skeptical about this, I understand. Because transparently, when I discovered this opportunity 2 years ago, I felt the exact same way. Before this network, I lost more than $100,000 investing into these so-called automation programs that promised ROI, but in the end couldn't deliver even a fraction of what they said. That's why our community focuses on actual results across the board, and not just one individual who has success and no one else sees the same results. But don't just take my word for it. Check out what some of our current clients have to say about our network.
The stock market is getting tanked right now, and that's no secret. I've been watching my stocks get wiped out for quite a few months. If for no other reason, I accepted this offer from ATN because I just wanted to have my money in a new venue.
We love seeing the consistent deposits, and we feel very informed, and we really like having you here to reach out to if we have any questions. So overall, it's been a great experience. The back end dashboard has been great, too, to have access to. So overall, it's been wonderful.
Just overwhelming, very surprised, skeptical at first because I had lost a lot of money in investment opportunities in the past. This thing works. I'm grateful now.
In terms of the ranking of the different 401k, stock market, ATN, Amazon, what would you say as far as a ranking?
Getting consistent stuff, I would say you'd be number one.
And that's just a handful of our current clients. But here's the catch. Due to the personalized, hands-on nature of the back-end process, we can only partner with a select number of individuals. But for those who we do partner with, we offer a completely hands-off experience where your account runs 100% on autopilot. Now, if this has piqued your interest, I invite you to click the link you see somewhere around this video and book a call with us. And we'll go into more detail about how we select our partners and how we can help you build the financial future of your dreams with no work required on your end. Still thinking it sounds too good to be true? Let us prove it to you. Click the link, book the call, and let us show you how ATN can transform your financial future. It's your time to turn your financial dreams into a reality. Click that link, and I'm excited to connect with you soon.
Hey, this is what I do almost every weekend, shopping real estate. You're probably not going to start with that deal right there or the one that I'm standing inside of right now, Sunday morning, but you need to start somewhere, okay? In about a week, less than a week actually, I'm going to be doing a live training for free, show you how to get started in the real estate game. I started exactly the way I'm starting right now with walking properties, looking at deals, hanging with my wife right there, underwriting deals, checking out locations. It's so simple to do this. You don't need money. You don't need credit. You just need to start. And I want to show you how to start It's completely free training. Take about 120 minutes of your time, and I'm going to put you in the game, I guarantee you. Click the link below. Register. This will be sold out like everything else I do. I'd love to have you be there to start your real estate career. Okay? Or continue with your real estate career. I'll show you some tricks you've never seen before. How to buy with no money down. How to get a loan below market. And how to ensure that your first deal makes you at least $1 million. That should be your goal. Your first deal should make you a millionaire. Imagine that, okay? Spend 120 minutes with me, and I'll show you how to put one deal on the books, your first deal, or your second deal, or your next deal. Oh, man, this neighborhood is fantastic, isn't it? I mean, look at this. All I'm doing is hanging with my wife, shopping real estate, and I'll know when I see a deal, a certain number of units, certain amount of rent, certain amount of upside, how to get the loan done. Like, I simplified this game so easily. I started with $3,000. My first $3,000 turned into $6,000. Had 100% return. I was like, oh my.
The stop sign. Turn right onto Gillespie Street.
You're telling me where to go right now. My first $3,000, I made 100% return in under a year, and I was like, I'm on my way. It wasn't a lot of money, but I knew I was on to something, okay? My second deal, no money down. Check this out, no money down. See, look at this little house right here. Somebody's going to make a fortune on that little house right there.
In a quarter mile, turn right onto Cedar Springs Road.
My second deal, I put no money down. I made $32,000. My third deal, I put $300,000 down and made $5.2 million. But check this out, and I'll be sharing this with you, how I took one deal. I owned it for 3 years. I made $144 million non-taxable, $144 million, and I paid no taxes. I'll show you how to do all that. Click the link below. It's completely free, no strings attached. You don't have to do anything. Just show up. I'll do the rest.
Hey, Bowtie Nation, Joseph Hogue with what could be the best way to look for dividend stocks to buy. You know, there's a lot of ways to look for those cash payments. We all love them. Sometimes dividends of 10 or 12% or more. Those monthly payers so often, especially for long-term holding those stocks, investors are disappointed because the dividend or the stock price just goes nowhere. That's why today I'm revealing 5 dividend stocks with the biggest dividend increases over the last 5 years. And more importantly here, financials to send those even higher, to put more cash in your pocket over time. In fact, one of these dividend stocks on our list has increased its dividend by 56% just in the last year, and a factor of 8 times over the last 5 years. Just imagine that, getting 8 times more of the dividend over 5 years. I want to get started on our first dividend stock here, Innovative Industrial Properties, ticker IIPR, but I'm going to show you how I found these and what we're looking for in these dividend growers next. IIPR is unique among real estate investment trusts, or REITs, in that it leases to companies in the regulated cannabis industry. Basically, the company has stepped in to meet that industry's limited bank funding to supply the real estate for grow and retail operations. IIPR owns 111 properties with 30 tenants across 19 states, and while that cannabis-related stocks have fallen hard over the last couple of years, consider IIPR more of a real estate play than cannabis. That's because the industrial and retail properties owned by the company can quickly be reworked to serve other industries. So even if the cannabis industry continues to flounder and go nowhere, I think IIPR has some underappreciated properties here that could be revalued higher. I'm going to put all our stocks in here along with the dividend yield, the dividend increases, as well as some of the financials that we're going to be looking at. Very important, these financials that mean that not only has that dividend grown in the past, but it will continue to grow in the future. We can see here, Innovative Industrial Properties, first on our list here, IIPR, has a dividend yield of 6.2%, a 5.5% dividend increase over the last year, which isn't anything to get excited about, just 5.5% increase over the last year, especially compared to another stock, our next stock, 56% increase over the last year. But really what we're looking at here is this 5-year dividend increase, this compound annual growth rate, okay, the average growth rate over the last 5 years, because 20% and higher is amazing. That's what's going to really make you more money over time. If we take anything close to that 1.2, 20% annualized over 5 years, take that to the power of 5 for 5 years, and we see that you will be making 2.5 times your dividend over in the 5 years period. Okay, so if they grow their dividend again 20% a year over the next 5 years, 2.5 times the dividend you're getting on that stock right now. We're also going to be looking at some of these other fundamentals here to make sure that they're putting more money in your pocket. Now, for Innovative Industrial Properties here, since it is a real estate investment trust, a REIT, I couldn't use the normal payout ratio or forward earnings growth for this. For a real estate investment trust, very important that you use the FFO, the funds from operations. That is a special calculation of cash flow for a real estate company, because these real estate companies have so much depreciation. All of these properties, they depreciate them each year. That skews the earnings. So you cannot use regular earnings metrics like the payout ratio, which for a regular company would just be the dividend divided by the earnings. You can't use that for a real estate company. You got to use the funds from operations. I'm going to show you how to do that. But for Innovative Properties, I went here to NAREIT, great data source here. We use this on our biweekly, monthly dividend stocks data. But you go here to REIT data and REIT market data. You come down here to REIT Watch, and that is a monthly publication covering all the REIT industry. It can give you a lot of great facts, a lot of great data on these. Increase this a little bit so you can see it, and move it over here. And now what we want to do, Control F to find IIPR, and that's going to find you all the instances of that. We're going to go clear down here to the bottom where it gives us the stats tables, the FFO per share, FFO estimates, growth, payout ratio, very important. That's what we're going to be using here, as well as that growth estimate. Okay, so we come down here to Innovative Industrial Properties. We can highlight that one so we can see the data from there. Okay, so what we're looking at here is the FFO payout ratio. Again, for these real estate stocks, funds from operations, that is basically your earnings, but taking out a lot of the things that skew those earnings. So depreciation on those properties mostly. And we're going to be using that as the measure of cash flow for these companies that can support growth, that can support those dividends, things like that. We do see here that the FFO payout ratio for Innovative Industrial Properties is 93%. That might seem really high, especially compared to some of these other stocks that we'll look at. EOG Resources, for example, has a 36% payout ratio. So you would think that Innovative is that dividend is not sustainable. It's paying out 93% of its funds from operations as a dividend. If those funds from operations goes down, it's not going to be able to pay those dividends. If it wants to grow the dividend, it's not going to be able to. But what you got to understand here is that because these are special types of companies, these real estate investment trusts are special types of companies, if they pay out most of their income as a dividend, they get a special tax break. So that's why these are almost always very high. Now, when we're analyzing these, we do want to compare it against others. We do see that Innovative Industrial Properties is a higher payout ratio than a lot of those others in the space, 74, 61, 42 here for LXP Industrial, which I've also covered on the channel here before, but I don't think it's too much of a problem. We do have a 4.2% FFO growth, so that is the growth in funds from operations expected over the next year. That's going to support that dividend higher a little bit and support this stock. As far as the outlook on IAPR, I'm not really positive on the cannabis industry. It is just not competitive with your corner pharmacy there or your corner drugstore there on the corner. But this is more of a real estate story here with interest rates coming down. That is going to be supporting property prices as well as property owners. That's going to give us a property rebound. And you also get that lottery ticket if cannabis industries do take off. Okay, so I think a lot of these properties can be sold off or repurposed for regular industrial or retail use. And if cannabis does jump higher over the next couple of years, you're going to see that in the stock as well. Talking through that first stock on our list probably gave you an idea of what I'm looking for in these dividend growers, but I want to walk you through this step by step. And Nation, this channel has never been about just dropping a list of stocks in your lap. I want you to understand how I found these, how to do your own analysis so you become the better investor. Otherwise, you're always going to be dependent on some Yahoo on YouTube for your investments. You can see I did the calculations here for you, but to show you how I found these, we're going to go here to Yahoo, and to find these dividend growers, I first look for stocks with a 5-year dividend increase of at least 20%. You can find these if you go, I use the stock screener on E-Trade, makes it a little bit easier, but you can also find these by going to a stock's historical data tab here on Yahoo. If you change the time period here, you change the time period to 5 years, and then historical prices, you show this to show dividends only and click apply. That's going to show you the dividends over the last 5 years, the entire dividend history of a company. And that's how I used these 1 year and 5 year rates. Now, there's a little bit different on some of these. That 1 year rate is easy. You can take the most recent dividend. So here for innovative industrial properties, you go here 1.9 in June, you go here to June 1.8. Okay, 1.9 divided by 1.8 is going to be that 1.055. Okay, so minus 1 is 5.5%. Okay, but some of these is a little bit different. Okay, one thing to watch for in these companies that pay special dividends on top of a base dividend or more variable dividends. You see these with a lot with energy space companies like Diamondback Energy. So if we see on the historical data here for the dividends for Diamondback Energy, we can see this is very much variable. And if you look through a company's reports, you can see how much the base dividend is as well as the total dividend. Diamondback does pay a base dividend of around, I believe it's about 85 cents a share, and then a special dividend, whatever additional cash flow it can pay out to investors. You can see this through here. You can see that over the last 4 quarters, if I add this up, it's going to come out to $10.76. So 2.34, 1.97.
Fist of Fury, Fist of Fury, come on. Ah, yes! Fist of Fury. Fist of Fury! Oh, oh! Oh. Oh. Oh, boy. Showtime. Barnacles, El Primo SpongeBob? Yes! Ah, I got water in my ear.
I'll let you in on a little secret. Ask your doctor about Slin. Thank me later. I'll let you in on a little secret. Ask your doctor about Slin. Thank me later.
3.37. Okay, so $10.76 over the last year in total dividends. And that's really what we're interested in here, right? It's total dividends. We don't care what was a base dividend, what was the special dividend, or what. We want to know how much money we're getting in our pocket. If we divide that by what they paid over the year before that, we get that 56% increase in the total dividend year over year. Now to find the 5-year growth in dividends, so that's the annualized growth each year. You do the same thing except for payment 5 years ago. Okay, so we're going to take our innovative industrial properties, the $1.90 per share dividend here in June 2024 that they paid out, go all the way down here to the September 2019, which was 0.78 cents. Okay, now, and again, this one with the ones that have special dividends are a little bit more variable. We took the last 4 quarters, added those up, and divided by the 4 quarters in the 5 years ago. But if we take this 1.9 divided by 0.78, we get a total dividend increase over the last 5 years with minus the 1. So it would have been 143% increase in that dividend for IIPR over the last 5 years. So that is very good. Here to get the 5-year rate, you go to this x to the y key, that is the exponent. So you go to there and then 0.2. Okay, 0.2 because 1 divided by 5 is 0.2. So for 5 years, and you get that 19.5% annualized growth in the dividend over the 5 years. Now, of course, a history of increasing the dividend doesn't guarantee those higher payments in the future. And for that, we're going to look at these fundamentals, the cash flow and the finances, make sure that they are able to keep paying that or keep increasing that dividend in the future. But first, it does show a company with a heavy commitment to that shareholder cash return, one where a company has been managed efficiently to put more cash in your pocket. Combining that with the commitment and that commitment with the fundamentals that we are going to look at, just going to give you a higher confidence that those dividends are going to keep on growing. And for those fundamentals within the financials, we're primarily going to be looking at these 2 percentages. Okay, first here's the payout ratio. You see that here in the column here. That's the percentage of earnings the company is already paying out to meet that dividend. So how much of the earnings, the profits the company is making every year does it have to put out as the dividends? And conversely, how much is it keeping back for growth? Okay, so what can those earnings do to make the dividend still sustainable or still growable? You're going to find this by taking the dividend amount and then dividing by the earnings reported by the company over the last year. Now, again, for the REITs, for real estate investment trust, that was different. We had to go look at the payout ratio on that real estate report. But for the other companies, you can do this yourself. What you're going to do, you're going to add up the dividends over the last year. So if we go back here to Diamondback Energy, remember we had that $10.76. It was $10.76 in dividends over the last year. Then what we're going to do, we're going to go here to the analysis tab, and that's going to show us the earnings estimates and revenue estimates for the last year as well as this year and the next year. So if you go here and you can find the year ago earnings per share was $18.01. So I did the calculations here for you on the chart here. I got prior year estimates or prior year earnings for all of these companies right here, and we do find that if we divide that $10.76 by the $18.01 prior year earnings, we do get that 59% payout ratio for Diamondback Energy. Again, with all of these, you need to compare that against other companies or the payout ratio with other companies in the industry. Okay, just different industries are going to have different payout ratios that are considered safe, where they can grow the dividend and where they can keep enough back to grow the company as well. So with this Diamondback Energy, you're going to want to go into stocks like Exxon. You want to go into stocks like Devon Energy, ticker DVN, another one that we've covered here on the channel quite a bit. Compare those payout ratios to see who's the safer payout ratio, who has the lower payout ratio here. And of course, lower is better with the payout ratio because it means the company has more room to raise that dividend or just to sustain it. But there is a caveat here that I am going to explain next. Now, for most stocks, a low payout ratio like this 36% here we see down here for EOG Resources, that means the company is holding back plenty of earnings for that growth. Okay, so paying out 36% of its earnings in dividends means EOG is holding back 64%, right? 1 minus 36% is 64%. That's 64% to reinvest or is going to be able to increase the dividend without a problem. It also means that earnings could come down and the company would still be able to cover that cash payment. That caveat there is something that I already explained here. You can't always compare those payout ratios just side by side for different companies. Real estate stocks, like we talked about, will have much higher payout ratios because they get that special tax break for passing all their earnings on to investors. So that doesn't necessarily mean that 93% payout ratio is dangerous for IIPR, though it is a little bit higher than I'd like to see. Even outside the REITs, though, in regular stocks, companies in different industries are going to have those different levels of payout ratio that are considered safe. Morgan Stanley, we're going to see here, has a 71% of its earnings paying out as the dividend versus just 52% for Goldman Sachs. So if we go back to that chart here, we can see that 71% payout ratio for Morgan Stanley versus 52% for Goldman Sachs. So that would mean that we can say that Goldman is the safer dividend here. Not necessarily that the 59% payout ratio on Diamondback is also safe. Okay, for that, we really need to compare it against the payout ratio in its past, in the company's own past, and against other energy stocks to really make that call. Finally, before we get back to our list, I also want to look at the expected earnings growth for these companies. Those earnings, that's where the dividend is going to come from. So if profits or earnings aren't growing, then the dividend probably won't either. For this, I went back to the analysis tab. You can see here the analysis for Diamondback Energy. We already have the $18.01 year ago earnings per share in this column right here. We put that into our chart, and we also have the expectations for next year. We don't want to use just 1 year earnings growth. We want to get a little bit longer term time period of what the market expecting this company to make as far as earnings. We'd see here it's $19.99 expected for next year earnings. So we got our chart here, and I did put this in. Now you can see just the last day, it's changed over the last day. That does happen. Yahoo Finance has an automatic survey of analysts when they update their own earnings estimates, price estimates, things like that. They do automatically get changed in here. So it can change day to day. Hasn't changed a whole lot. So we're still going to use that $20.13 earnings expected for next year for our calculations here. So you can see here prior year earnings, next year earnings, and you can see here the forward earnings growth calculation. What this is you just go in here to your calculator. You take that next year's earnings growth, 20.13, divided by 18.01. That's the 2 year annualized or 2 year growth rate, right? 11.77% growth over the next 2 years to find an annualized rate on that. So a yearly average rate, you just again go to our little X to the Y here and then 0.5. Okay, so because 1 divided by 2 would be 0.5, right? So 0.5 is going to be your exponent equals, and then you get that 5.7. Okay, with these, you always got to minus the 1 out. So you get the 5.7% annualized earnings growth. Okay, so that's very important in telling us, okay, we've got the payout ratio. We know how sustainable that dividend is, but how much can it grow? Okay, a company with 5.7% earnings growth a year can't be growing its earnings by 50% every single year, right? It just wouldn't happen. This payout ratio would shoot up to past 100% and they wouldn't have the cash available. but it can be, especially with that lower payout ratio, the 60% payout ratio, it can increase its dividend a little bit more than the earnings growth each year. Okay, so we've got 5.7% over the next year. Not great, but and not as good as it's been in the past. But still, I think this dividend can go up 10 or 20% over the next year. Taking a closer look at that Diamondback Energy, ticker FANG. Again, an oil stock we've had off and on here on the channel and have done really well over the last 5 years. You can see here where the price of oil really bottomed after the pandemic and how far this stock has gone, along with other favorites like Devon Energy, DVN, Chevron, ticker CVX as well. And that dividend has really followed this stock price all the way up. You can see right now it is a dividend of 5.85%, which is very strong for these non-real estate, non-BDC stocks. Okay, any regular dividend stock that pays 5.8% is something to watch. Now, Diamondback and other energy stocks have banked on that record U.S. oil production over the last 5 years. No other area has really benefited as much as from that Permian Basin where the company has its assets. Lower oil prices have also weighed on the stocks lately, but the company is very well managed. It's turned just 3% increased oil production this year into an increase of 7% in the base dividend. So very efficiently run company. We see here FANG is an industry leader in that cash flow generation, producing one of the highest cash flow margins in its peer group and just gets more out of its spending. This bottom chart here shows the company gets 41 times its capital spending in oil production. Okay, 41 times what it spends, it gets it back in oil production, well above the other companies in its industry. And that's the kind of efficiency that's going to continue to generate that cash flow growth and grow the dividends. So here we do see that dividend yield. If it was 5.7% yesterday, now it's 5.8%. Stock prices come down a little bit, and we see that 1 year and 5 year growth, the best in the group here. Again, with those higher oil prices, especially over the last year, especially over the last 5 years, this company has increased its dividend by a compound annual growth rate of 52% over that period. An enormous dividend growth. I obviously do not think we're going to see that here. These oil stocks have been weak since March on fears really an economic slowdown is going to weigh on that demand for oil. And the price that we've seen lately has come down under $70 a barrel. That said, these oil stocks are very well cash flow positive, even at $70, even at $60 per barrel, and are going to be able to sustain that dividend. This is one reason why Diamondback Energy does have that base dividend and then pays out anything extra in that special dividend. So you're still going to get that base dividend. The price of the stock may suffer for the next quarter or two. That dividend growth for sure won't hit 52% annualized next year, but this is the best oil stock for the rebound and still cash flow positive here. So it's going to have the best assets in the country, and I think this is the one to own in the energy space. We still got 3 more dividend stocks to highlight and 3 stocks to watch, but I want to get your opinion on this as well. We can look at dividends a lot of different ways, from highest yields to the most years consecutive payments to the safest, the fastest growers like we're looking at here. But like the man said, you can't always get what you want. Maybe that analogy doesn't quite work, but it's the stone, so I had to try anyway. Anyway, you can't always get everything in dividend stocks. So what's important to you? What are you looking for? Let me know in the comments here. What are you looking for in most of your dividend stocks? The highest yield? Are you looking for the highest total return with dividends and price? Maybe just the most dependable or safest. So tell us the metrics you use to find your own dividend stocks in the comments. We'll try to do some videos on those as well. Next up here on our list, Tronox Holdings, ticker TROX. You can see it's almost got a 4% dividend yield, so a little bit lower, but very strong dividend growth in the past. So again, might be low now, but if it keeps on growing at that rate, and I think it can do pretty well in the future here, you're going to get a lot more for your money. With $2.3 billion in revenue, Tronox is the world's largest vertically integrated producer of titanium dioxide pigment, a chemical used in pretty much everything from cell phone screens to paints and AC filters. So very much a stable demand chemical here. Being vertically integrated from its mines to processing, means the company controls its own feedstock and can get that better control on pricing. Here you can see that dividend yield, 3.8, 3.9%, right around there. It hasn't grown in the past year, so that is a problem here. We did see 22.7% 5-year compound annual growth rate, so very strong growth rate, kind of showing us that commitment that management has to returning that cash holder share return. So this is probably the probably the most awkward stock here, probably the riskiest stock, and maybe the one I'd buy last if you were just trying to decide which of these stocks to buy. Okay, just because it did have, we see that negative payout ratio because it did have negative earnings over the last year. So a little bit coming off of a trough in earnings, but we do see that forward earnings growth, that expected earnings growth of 786%. Again, we can go in here to the analysis, see what analysts are talking about for this company. We can see that it did have negative 15 cents per share earnings per share over the last year. We'd want to look into that to see why they had that earnings per share negative last year and why it's rebounding so much this year and next. We got 42 cents this year, $1.33. We do see 11% and 6% earnings or sales increase. Now, this is the smallest company. It's just a $2 billion market cap and is exposed to those ups and downs in one specific chemical. So not only in that earnings variability that we saw, but also just the business fundamentally is more risky, is riskier than a lot of these other larger companies. About that wide use for titanium dioxide is a plus. It is a very, very much a demand use case across industries and gives the share some stability with that. I do like the company. I think the company is riding its earnings slump, and we should see that return to a strong dividend growth. Next up here, Morgan Stanley. We're going to see in our table that the banks have just become cash flow machines with 35% earnings growth, but these aren't really like a lot of other banks. Okay, with Morgan Stanley, and later we'll look at Goldman Sachs, we're talking more about the asset managers and the investment banks. It's in those business lines that have really helped insulate the two, these Morgan Stanley and Goldman, from really those interest rate and deposit problems you see with the other banks that we've seen over the last year. We do have the 5-year chart for Morgan Stanley here. You can see that not only has it increased the dividend by a pretty good factor there, it has also increased the share price. So you're getting a great total return there. In fact, when I was working with venture capital, it was always these investment banking guys, right? The investment banking guys at Goldman, at Morgan, and that we tried to beat in terms of returns and deal volumes. You know, I'll admit venture cap makes some very solid returns. We made great money there in venture capital, but the cash and just the deal sizes for IB is working that can be insane. You see here in our chart, the 3.7% dividend yield is the fourth lowest on our list. But again, don't get caught up in these dividend yields, because if a company is growing its dividend by 10, 20% a year, you're going to be making a lot more of that just in just a few years into the future. We can see that Morgan Stanley increased its dividend by almost 9% over the past year, 21% over the past 5. And again, to get an idea of how much that is, if you go 1.215 and then you do your exponent 5, that is 2.6 times. So over those 5 years, investors in Morgan Stanley saw their dividend grow 2.6 times as much as when they bought the stock. So that is something that's hard to ignore, even with that 3.7% dividend yield. Payout ratio is a little bit higher, like we talked about. 71% of Morgan Stanley's earnings are going to pay that dividend. That is higher than the Goldman Sachs that we'll see. And we'll see that the earnings growth, 21% expected earnings growth over the next 2 years, isn't quite as high as Goldman Sachs. So I would probably maybe defer to Goldman Sachs. It really depends on what you want in your dividend yield, okay? That Goldman Sachs dividend of only 2.4% really doesn't qualify it as a dividend stock in my book. I want to see a dividend yield of 3% or more. But if it is growing its dividend faster, if it is going to be able to do that faster in the future as well with these earnings, with these forward earnings expectations, then maybe you want to give that Goldman Sachs a look instead. I'll show you that next dividend stock, and the 3 I'm also watching, but I realize these dividend yields in this video might not trip your trigger, even if they are growing them by double digits a year. For the highest yields I've seen, check out this video and see how the QDTE, that weekly dividend fund, is producing a 62% dividend and paying it on a weekly basis. Got another energy stock here with EOG Resources, ticker EOG, though it is different from a lot of the other oil stocks we're looking at. I'm going to show you why in its business model here. We can see the dividend yield of 3%, a little bit lower than we'd like to see, but with that price return and what I think can be very good dividend growth over the next couple of years, I think this is one definitely to look at. That's because EOG is one of the largest natural gas producers with operations across the United States. Now, while the company does produce some oil, natural gas production of 10,000 equivalent barrels a day, or about 85% of its total volume, makes this one almost a pure play on gas. While the price of oil has held up against that record production, the price of natural gas is down nearly 40% since late last year. That's because a mild winter heating season last year, really along with record gas production as kind of a byproduct of oil drilling. So when these producers, they drill for that oil and they produce oil, out comes some natural gas and they bottle that up and sell that as well. All that drove those natural gas inventories to 40% above the 5-year average this year. That really crashed the price. Now, a drop in production by some companies, including EOG, and hot summer cooling season has helped to bring those inventories down. But again, they're still well above the average. And another warm winter this year would be very bad news for these producers. That said, EOG has worked to become more efficient, having its price required for that 10% ROE on oil and bringing down to just $2.50 per million BTU on gas. That's helped to increase its free cash flow even on this lower prices and sustain that dividend. Here we do see the dividend yield was 3.4% just a couple of days ago. When I put this data together, the price of the shares has come up a little bit, so the dividend yield has come down 3%. Good for investors that own the stock, though. Price has come up. Still a an excellent dividend increase over the last year and 5 years. We see 22% increase in the dividend over the last year, 26% annualized over the last 5. So despite that weakness in natural gas, the company has become more efficient, been able to send more cash back to investors. We do see the payout ratio very low, 36%. In fact, one of the lowest payout ratio on our list here, much lower than Diamondback Energy, the other oil company on the list here, 36%. That means EOG is going to be able to reinvest in the company, keeping a lot of earnings growth or earnings back for reinvestment in growth. And it's also going to be able to increase that dividend. Even if those natural gas prices stay lower, it's still got plenty of room there in the payout ratio. Forward earnings growth, the earnings expected over the next 2 years from analysts, not great there at 3.7%. Obviously, that's going to hamper or hinder what the company can increase as far as dividends. But it's all really the short term. The outlook depends on this winter. That's because a cold or even normal winter can see a lot of that gas inventory cleared out. And the recent production cuts announced by a lot of these companies, including EOG, could turn the market to a deficit fast, which would in turn spike the price of natural gas and stocks like EOG. Another mild winter would see inventories build and the stocks suffer here. But this is a best-in-class producer, and natural gas demand is growing with that renewables use. So longer term, we should see good cash flow growth and dividends from EOG. Other 3 dividend growers also made the list for a few different reasons, though they didn't have that yield that really makes them a dividend stock in my book, right? Again, I always like to see a yield over 3% on my dividend stocks. On the other hand, if they do keep growing that dividend at this 5-year rate, in a few years, you could be collecting a dividend yield in the double digits on your original investment. So we've got stocks like Goldfields Limited. Gold prices reaching record highs here. These gold companies are very strong cash flow positive. I don't know why they haven't. Why they're only paying out 2.8%, but they have grown it by 30% a year. One of the highest 5-year growth rates on the list here. Only paying out 42% of their earnings, so plenty of room to increase those dividends, and a 40% expected earnings growth over the next 2 years. Okay, so we're seeing those high gold prices come through in the earnings for these gold companies. 40% earnings growth, I guarantee you they are going to be increasing that dividend, especially more than they actually did cut the dividend over the last year. We'd want to look in to see why they cut the dividend slightly there, but 40% earnings growth over the next 2 years, they're going to be able to increase that dividend quite a bit. Ares Capital Management here, ticker ARES, also made the list, only 2.6% dividend yield, but very strong 1-year and 5-year rates. This is a BDC, so this payout ratio is a little misleading here. Those BDCs, like the real estate investment trust, have to send most of their cash flow back to investors as dividends, so they keep very little left. The 101% is a little high, but it is sustainable here with the 25% earnings growth, as well as some of the other fundamentals for the company. And of course, Goldman Sachs, we've talked about here, at 2.4% dividend yield, the lowest on our list, but very strong 5-year dividend increase, very low payout ratio, even compared to Morgan Stanley there, and that forward earnings growth of 35% a year, going to be able to increase that dividend quite a bit. Check out the video on the right to see how the QDTE is producing a 62% dividend yield and putting cash in your pocket every single week. Or look in the description below for other dividend stock videos that you might like. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification. Stocks are crashing from their highs, with the market suffering its worst day since 2022 last week, and heavyweights like Tesla and Nvidia down double digits. Investors are rushing to hit the sell button. But have you ever sold a stock only to watch it rebound higher? Have you ever held on to a losing stock, watching it sink lower and wish you sold sooner? So the question is, when should you sell a stock? If you think about it, it's the only investing question that really matters. Until you sell a stock, any return on that investment is just on paper. You haven't booked that return until you sell. And most people say they're investing for the long term, but data says otherwise. Data from the New York Stock Exchange shows the average holding period for a stock has plunged from an investment of 8 years in the 1960s to just 5.5 months. Investors are selling their stocks in less than half a year. I'm going to reveal the only 3 reasons to sell a stock for a profit, and then 4 rules for when to sell at a loss. Make sure you stick around because the rules for selling in one scenario at a profit are different for when you sell at a loss. I'll also show you an alternative strategy to selling so you can ride your stocks higher while still locking in those hard-earned profits. And of course, the best time to sell a stock is at a profit. So let's start there with the 3 rules for when to sell your stocks that are going up. But understand, you're not selling just because the stock price has gone up. I see too many investors getting excited and selling a stock that has jumped higher after a quick 30 or 40% return. Headlines start saying things like too far, too fast, and analysts start warning of getting overly excited. For example, investing in shares of NVIDIA June 2016, you would have doubled your money in just 5 months, but hold on to a great company and it went 16x in 5 years. Amazon produced a 96% return in less than a year from its 2002 low. Take that profit and you would have missed out on your chance to get 181 times your money. Nation, the fact is the stock market is pretty smart and forward-looking. If a stock is booming higher 20 or 30% and more in a short period, there's usually a very good reason why. Yes, it might give back some of that return short term, and it sucks to see a windfall evaporate, but it's more likely that that competitive advantage that the company has that caused that boom is going to continue long term to take the shares higher. So we're not selling just because the price has gone up, but there are other reasons to take that money and run. And the first is to just rebalance your portfolio. This is when 1 or 2 stocks have shot up so far that your portfolio is basically just those stocks. For example, let's say you had a portfolio of $100 in Tesla and $100 in that broad S&P 500 stock index in 2019. Within a couple of years and a 14 times return on Tesla, you would have 90% of your money in just the one stock. Now, that's obviously an extreme example, but it does happen. I've seen investors with portfolios almost entirely in just 1 or 2 stocks. And folks, no matter how great a company is, you never want to bet your financial future on just one stock. Fail to rebalance, and that 15x windfall with 90% of your money in one stock crashes along with that stock. For that reason, I usually limit the percentage of my portfolio in any individual stock to no more than 5 or 7 or even as high as 10%. You could make the case for higher if you really like the company, but once the stock reaches 20% or more of your total wealth, you need to take some of those profits and just spread your risk out into other stocks. And rebalancing is as simple as putting some of that money in your other favorite stocks, or just putting a little more in the broader stock market ETFs, like the Invesco NASDAQ 100 QQQ, spreading your risk across 100 stocks instantly. We're just getting started, but one of the best ways to know when and at what price to buy or sell a stock is through what's called technical analysis. To help you out here, I'm relaunching my technical analysis course with a 30% discount. Save 150% off the regular price. The complete course includes more than 30 videos on how professional investors trade stocks, the buy signals, the sell signals, and the technical analysis they use. You'll also get the bonus material on fundamental analysis, trade examples, and trading worksheets to follow your trades. Click through the link I'll leave in the description and check out the free preview or try it risk-free for 14 days. You'll learn how to find the stock trades and never run out of ideas, how to identify price changes before they happen, and the top trading patterns used by professional traders. That relaunch discount, though, save $150 off, is only running for the next 3 days or the first 40 students, so make sure you check out that link below. Your second reason to sell a stock for a profit is if the company gets bought out. You might not have a choice here. If the company you own is acquired for cash, then you're going to get the cash value when the deal closes. If it's a stock-for-stock acquisition, though, meaning investors get shares in the buying company for every shares of the acquired company they own, you're going to probably want to take that money and run. That's because the average price in acquisitions is 30% higher than the market price. Investors get a quick 30% bump when the company they own is bought out by another. After that, returns are not so great. Multiple studies by the Fuqua School of Business at Duke and the University of Washington shows returns for buying companies, the stock you would get if the stock you own is acquired, produce substandard returns for years after the deal. Less than half the return you got before the deal. So if a stock you own gets bought out and you get the shares of that buying company, unless you really love that buying company. Sell and take the money. Let's look at the third reason to sell for a profit. Then I'm going to reveal an alternative to selling and 4 rules to sell a losing stock. And this one is what most investors think of when selling. Risk of a stock bubble or the drop in that one stock or an overall market crash. But surprisingly, this is the weakest reason to sell because we don't want to be trying to time the market here. An expensive stock can keep running higher, and a bubbly market can just keep inflating. Before the 2008 crash, analysts and so-called experts were calling it a bubble as early as 2004. Michael Burry not so famously started warning of a crash that year, before a 60% run in stocks over the next 4 years. So here, even if you're very sure on this, I would only start selling a portion of my stocks. Only if the market is grossly overvalued and the Fed is looking to start raising interest rates, and then start by only selling 10% of your stocks every 3 to 6 months. That's going to lock in some of those returns, give you the opportunity to rebalance into safer investments that won't fall in a crash, and take advantage of lower stock prices if the market does come down. Now, I want to give you an alternative to selling a stock that is running higher because, why sell a stock that's doing what it should? You want to ride that gravy train for as long as possible, and here's how to do it with less risk. Our alternative is called the covered call strategy, and I'll use an NVIDIA here as an example. Say you went big into NVIDIA a few years ago and have seen that massive run in the shares, but now you're a little worried about the future, or maybe you just have too much in one stock. You can go here to the options tab, and this is a strategy you can use on any investing platform. There are weekly, monthly, and even long-term options available, but we don't want to be doing this every month. So I'm going to use the long-dated January 2026 options. That means the options we're selling against our stock expire on that date, almost a year and a half from now. And we can scroll down through these call options, and the price in blue here is called the strike price. It's the price at which you're going to allow another investor to buy the stock from you. You're selling them the option to call or buy the stock from you. So we scroll down and we want to give NVIDIA some room to keep on going. So we're going to agree to sell it for $150 a share. You can see that still gives us another 29% upside on the shares. Here's the really great part. For that option, the other investor is paying us $20.60 a share right now. Money you get immediately in your account. In effect, you're transferring some of that risk in shares of NVIDIA by selling these options. So that $20 cash you collect, divided by the current stock price of $116 a share, you're collecting an almost 18% return on the stock. Shares of NVIDIA could fall by 18% and your portfolio wouldn't be hurt because you collected that money. Think of it another way here. If NVIDIA moves above $150 each by that expiration date, then you get that amount for the shares, plus the $20 you already collected. That's an additional 47% return on your shares, along with major risk reduction. I know options investing can seem like a foreign language, so I'm going to link to a video in the description that goes into more detail, as well as a special coupon code on my full options course with 29 strategies. Most investors don't think to sell a stock at a loss, instead holding on too long to their losers, just hoping to get back to even. Selling those losing stocks early, though, is one of the most important decisions you can make, saving you money to push into your winners. So I want to give you 4 rules for when to sell a stock at a loss. And again, just like we saw earlier, we're not talking about selling just because the price has gone down, though. You bought that stock for a reason, hopefully because you researched the company and liked that long-term outlook. When a stock falls, the best lesson you can draw from it is evaluating what went wrong in your analysis, or if you were just early on the stock. Even if you do plan on keeping that stock, one of the reasons you might sell is to save on taxes with tax loss harvesting. That's because you pay capital gains taxes every year on any stocks you sell for a profit. Long-term cap gains can be as high as 20%, and short-term gains are added to your income and taxed as high as 37%. But you can offset your profits with losses. That means any loss you take after selling a stock reduces the amount of total capital gains and the taxes you'll pay. Now, if you do want to hold on to that stock long-term, but also want to use some of that loss to lower your taxes, you can buy it back, but not within 31 days. So that means you don't want to sell your stock if an earnings report or news is expected within the next 30 days, but you can keep general exposure to that investment by buying an ETF in the theme or just a related stock. For example, say I wanted to use some of the loss on my shares of ChargePoint Holdings, but still want to keep my position in that long-term upside. I can sell my CHPT shares and buy competitor EVgo, which tracks ChargePoint very closely. or buy the Electric Vehicle and Future Mobility ETF, ticker KARS, for that overall theme. So this tax loss selling isn't the kind of selling investors usually think of closing a position for good, but can save you thousands of dollars in taxes. Another reason to sell a stock, even at a loss, is if you're going to need that money in less than a year. This one hurts because for a lot of those loser stocks, you just know deep in your bones that they're going to rebound if you give them time. But here, time is something you do not have. If you need a big chunk of that money for something within the next year to pay for expenses, for school tuition, anything that can't be put off for later, you need to get it out of the stock market. And folks, I know interest rates on savings and CDs are crap, but the stock market is no place for this short-term money. Any big bills you need to cover in 6 months or less need to stay in cash, and anything even 6 months to a year shouldn't be in any investments riskier than treasuries, CDs, or money market accounts. Reason 3 to sell a stock at a loss is on news or material change in the company's outlook. Basically, something that forces a major change to why you bought the stock in the first place. Now, every investor needs to keep a spreadsheet or some kind of notes for each stock in their portfolio. Here you're going to write out not just the reasons you bought the stock, but also that bear case, kind of like a pros and cons list for the company. Note any competitive advantage you think the company has, along with market share versus its peers and its evaluations. I know this is a hell of a lot more work than just letting some Yahoo on YouTube pick your stocks, but folks, you need to take responsibility for your money. It's only with tracking your stock analysis that you're going to be able to go back if the price falls and evaluate why it went wrong. Then you can decide whether the reasoning has changed enough to sell the stock if you want to hold on, or maybe even add more shares to lower your price. But above all, this is the only way you learn from your mistakes to become a better investor. We still got one more rule for when to sell a stock, but if you're wondering where to put that money or worried about your hard-earned profits, check out this video next for the 7 safest investments ranked. Found another stock that you want to buy. I say dangerous, not because it's not a very smart decision when it needs to be made, but because we investors are like cats chasing that damn red dot. It is so easy to jump around from stock to stock and never catch the returns we need. But there is nothing wrong with ditching that dog of a stock if you've done your research and found another with higher return potential and a higher level of confidence. Revisit the research for your losing stock, compare it with this new research, maybe even sleep on it for a couple of nights, and then make that decision that keeps your money working for you. Don't miss the relaunch of my Stock Signals course. Look for the link in the description and save $150 off. See the technical signals professionals use and exactly when to buy and sell a stock. Or click on the video to the right for the 7 safest investments ranked. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification. Hey Bowtie Nation, Joseph Hogue with one of the most popular strategies on the channel, creating weekly dividend cash flow, because who wouldn't want those dividend checks every single week? In the past, I've showed you how a simple portfolio of monthly dividend stocks work together for those weekly dividends. Now there are ETFs, new funds that can put cash in your pocket, and with yields as high as 62%, 50 times the market average, and even 5 times the dividend on the popular QYLD income ETF. But which is better? The DIY approach, buying your own individual stocks, or just putting your money into an ETF for that weekly cash flow? I'll detail the 2 weekly dividend funds, how they work, pros and cons, as well as one popular weekly ETF that just imploded. Then I'm going to show you how to put your own stocks together, a simple 4-stock portfolio that also gives you weekly cash and a 13% yield, before comparing the strategies to help you decide which is better. Let's get started with the Roundhill Innovation 100 Zero DTE Covered Call ETF, ticker QDTE, a new dividend fund out since March. The QDTE is similar to the popular QYLD Covered Call ETF in that it uses call options to create cash flow to pay dividends, but with a high-yield twist. The fund invests in what it's calling the Innovation 100 Index, and this is actually kind of funny because what it's doing is investing in the stocks in the NASDAQ 100 Index, same as the QYLD ETF, but if it came right out and said NASDAQ 100 in its documents, it would have to pay a licensing fee to the NASDAQ company, which has a copyright on that index. Instead, it set up an equivalent index with the same 100 stocks and avoids that licensing fee.
I own a lot of businesses, so my tech and my network need to keep up. Thank you, Verizon Business.
Now our businesses get fast and reliable internet from the same network that powers our phones.
So whatever's next, we're cooking with fire.
Switch to the partner businesses rely on.
Anyway, the fund invests in the 100 largest companies on the NASDAQ exchange, mostly tech stocks here, and then every day sells call options against the position. Remember, selling call options means that you sell to someone else the right to buy those stocks from you at a set price for a set period. And for that, the other investor is going to give you a cash premium right now. A cash premium that the fund uses to pay those huge dividends. An example is going to make this a lot easier to understand. Here we see shares of the Invesco QQQ Trust, the ETF that invests directly in those NASDAQ 100 stocks, just like the QDTE fund. That QQQ fund closed at $480 a share last Friday. Here we can also see the call options available that expire the following Monday, so the 0-day to expiration options. Now, if we sold the calls with a $485 strike price to another investor, that means the other investor would have that right to buy our shares of QQQ for that amount, that $485 each on Monday. Now, for that right, the other investor is going to pay us this 25 cents per share. Now, that might not seem like much, just 0.052% on that $480 strike price, but it's also the single day, and we can do it 5 days a week. If we repeat that all week, that is a 0.26% return, or $1.25 on our shares in cold hard cash. Annualize that amount, so repeat the process every day for the roughly 250 trading days in a year, and you've collected $312.50 in cash, or about a 65% dividend yield. Of course, there is a risk here. Selling those call options, you're giving the other investor the right to buy those shares from you for that $485 each. So if the QQQ rises by over 1% to over that amount on Monday before the options expire, they'll buy them for that $485, no matter what the market price is. So let's say the NASDAQ jumps 2% on Monday to $489.60 a share. You've already sold this other investor the right to buy them for $485, so that's the cap on your return. You still collect and keep that 25-cent cash flow and the $485 option strike for your shares, but you wouldn't see the extra bounce on the market. So that's the risk that this QDTE and all these covered call income funds are taking, as seen here in the fund's marketing documents. That covered call strategy, the graph on the left, caps your potential return in exchange for that cash payment. Sometimes it works in the fund's favor. Sometimes they collect that cash payment and the stock it holds go nowhere or even fall a little. That means the fund is going to keep that cash premium and the shares and can sell more calls the next day. Other days when the NASDAQ jumps and those shares are called away by the other investor, the fund has to buy the new shares so it can continue to sell call options against them and collect cash on those for the dividends. But the strategy has worked very well for the fund since March. We can see its dividend payments and calculate the yield here on Yahoo from the historical data tab. Change the time period to max, and we see the inception March 6th, and then to show dividends only, and we see every dividend paid since that first one, March 26th. Now, one problem here is dividends on these income ETFs are very unreliable. It's paid out as low as 9 cents a share in April and as high as 56 cents a share recently, but you never really know. It just depends on the volatility in the market because those call option premiums rise and fall with volatility, with that market uncertainty. We do see it's been able to pay dividends every week, which is a big change from the normal 3-month quarterly payments we see in most dividend stocks. Now, assuming, and this is a giant assumption, but assuming the fund continues to pay out that same dividend it has over the past 4 weeks, so adding up these last 4 dividend payments up and divided by 4 for an average, we get just under 51 cents a share each week. If it does that 52 weeks in the year, we get a total annual dividend of $26.45, which because of holidays and volatility changes, it won't do exactly this much, but for simplicity's sake, we're going to assume this amount. If we take that annual dividend divided by the current stock price, we get a 61.7% dividend yield, which is unheard of. And before you get too excited, I want to show you how this can change so quickly. So let's go back and recalculate the dividend using the payments from May when volatility was lower and those call options didn't pay quite as much. If we add these up and divide by 4, we get about a 20 cents per share weekly payment on average. Then we see the fund was trading for there in mid-June at around $45.75 a share. And if we take that average dividend payment times 52 for the yearly amount, and then divide by the stock price then, we see the dividend yield was only 22.7% at that point. That is still a hell of a great dividend payment, but nowhere near the 62% yield on the other estimates. So You can see how this can all change quickly. Now, I know this is a lot of numbers, but I want to highlight one more weekly fund, the Roundhill S&P 500 Zero DTE Covered Call, the ticker XDTE, before we talk about pros and cons here. The two funds use exactly the same strategy, except against a different set of stocks, where the QDTE invests in those NASDAQ 100, the Innovation 100 tech stocks. The XDTE holds stocks in the S&P 500 index, so the 500 largest companies based in the U.S. It's funny again here, though, because it explicitly says the S&P 500 index in its marketing. That means Roundhill is paying the S&P the licensing fee to use that index, rather than its approach with the other index. Maybe they just couldn't come up with another name for the S&P 500 index, like the Fabulous 500 index. So just like the QDTE uses a similar strategy with the QYLD income fund, except with those 0 day to expiration options, the XDTE is similar to the S&P 500 covered call ETF, the XYLD, except with those 0 day expirations. And so you kind of get a sense that, okay, is Roundhill just copying this ticker symbol from Global X covered call funds, the QYLD and the XYLD, and just using the DTE in their ticker? So XDTE or QDTE. We can also do the same dividend yield calculation here we did with the QDTE. Going to the historical data and changing the time period to max, we see the fund started March 6th, just like its QDTE. Changing to show dividends only, we see the payment history and every week back to March 26th, and the same dividend uncertainty. Payments have been as low as 2 cents a share back in April and as high as 41 cents a share earlier this month. Now again, most of that has to do with that amount of volatility in the market, how much prices are swinging up and down, and how much the fund can collect with that option strategy. But if we add up these recent 4 payments and divide by 4, we get an average dividend of 38 cents a share, and times 52 weeks, a dividend of almost $20 per share over the year. And again, please understand, this is not what you're going to collect over a year. We've seen how those dividend payments rise and fall from week to week, and averaging the most recent 4 weeks, which have been exceptionally high because of volatility, is without a doubt overestimating the real dividend yield here. But I want to show you how to calculate this on your own. Anyway, if we take that 1-year dividend estimate of almost $20 a share and divide it by the current stock price, we get a dividend yield of 38%, which is lower than the QDTE, but still amazing in the world of dividend stocks. The difference in those yields just goes back to the stocks each fund holds and the volatility. NASDAQ 100 stocks, so that mostly tech stock index, is quite a bit more volatile. The stock prices move up and down quite a bit more from day to day compared to stocks in the S&P 500 index. So that volatility means those option premiums are higher. If you're willing to sell a call option to another investor, but there's a higher likelihood that the stock price could go much higher, then you're going to want a higher cash premium. So that's why the yield is higher on this QDTE versus the XDTE fund. I'm going to detail the pros and cons of these funds next, but I also want to personally invite you to get the Weekly Bowtie, our free weekly newsletter with all the stock market news, strategies, and trends you need to know. Each week before the market opens, I'll show you what I'm watching and the stocks that could highlight the week. It's all totally free, just something I like to do for all you out there in the community. So look for that sign-up link in the description below. The biggest upside to these weekly dividend ETFs is just a higher potential yield. Selling those daily call options versus the monthly strategy we see with the QYLD is just mathematically going to give you a higher cash flow potential if it's managed right. And we're going to see next in the cons that it might not be managed. But if done well, you've got the potential to collect dividend yields of 60% from these weekly funds versus less than 3.5% on regular dividend ETFs like the Schwab US dividend, the SCHD, which I do also like, or even the 12% yield on the NASDAQ 100 covered call QYLD ETF. That weekly cash payment also means more motivation and makes it easier to live off your dividends. You don't pay your bills every 3 months, so investors love these monthly dividend stocks, but even easier is being able to depend on getting that cash flow every single week or whenever your bills come due. For those not living off their dividends yet, seeing that cash payment hit your account every week, that ain't bad either. But like we say here on the channel, it ain't all rainbows and unicorns. Both the QDTE and the XDTE charge a 0.95% expense fee, which is a huge fee compared to most other ETFs. For example, you'll pay just 0.03% to hold the Vanguard S&P 500 ETF, the VOO, or 0.06% for the Schwab Dividend Fund, that SCHD. That's a management fee of just 60 cents for every $1,000 invested, as opposed to $9.50 for every $1,000 you'll pay holding the QDTE weekly ETF. Even that QYLD monthly fund charges a high, but still lower 0.61% expense fee. Now, part of that higher fee is that the QDTE and the XDTE are just starting out and need to collect more on that lower asset base. With just $128 million in assets in that QDTE, even that nearly 1% expense fee is only about $1.3 million in fees to cover its costs. Compare that with the $50 million in fees GlobalX collects on its $8.2 billion QYLD ETF. Part of the higher fee, though, on that QDTE is also because that daily option strategy is just more management intensive and more expensive to operate. So even if assets do rise in this fund, I don't expect the expense ratio to come down too much. Another downside is going to be a higher volatility in the price versus those monthly dividend funds. We see in both the QDTE versus the QYLD and the XDTE versus the XYLD, the stock price for the weekly dividend funds rises and falls faster. The volatility in those monthly dividend funds is high enough. So if you're one that loses sleep when that roller coaster gets moving, you could be pulling your hair out watching the portfolio on weekly dividend funds. We already saw how that dividend payment can change from week to week. It's a nice surprise when it rises steadily from 14 cents a share in June to a 56-cent dividend in August, but that payment can fall as well. That makes it tough if you're living off your dividends, so definitely a drawback for some investors. Another con, these weekly dividend funds will likely underperform their indexes and possibly even the monthly dividend funds as well. Here we see the QDTE weekly fund versus the QYLD since March, with the monthly dividend fund almost breaking even on a price versus a 4.8% loss on the shares of the QDTE. And it's the same picture in the XDTE, with the weekly dividend fund losing 1.2% of its value over the last 6 months, versus the monthly dividend fund, the XYLD, up 1.9% over the same period. Of course, that massive dividend yield makes up for a lot of this. Using stock prices adjusted for dividends, so including the dividends you would have collected, we see the weekly QDTE has produced an 8.15% total return over the 6 months. That's higher than the 6.37% total return on the QYLD, though it's still below the 10.3% total return investing just in the QQQ itself. So just buying those NASDAQ 100 stocks outright. So now purely on a price return, you're likely going to see your shares of QDTE fall and underperform the QQQ index and maybe even the QYLD. Comparing the 6 month charts in the QDTE and the XDTE with those monthly income funds, we see the same weakness in the weekly dividend funds in April and again in mid-July to August. When the broader market falls, the QYLD and the XYLD fall, but those weekly funds, the QDTE and the XDTE, fall even harder. And we don't know yet, but it may point to a problem with how these weekly funds are managed. Because the QDTE is buying call options rather than actually investing in the 100 stocks directly, the value of those assets in a fund is going to fall faster as the market drops. It's a more complicated strategy and may contribute to these lower returns as stocks fall, but it's not a guaranteed disadvantage. It just depends on how the funds are managed. We see one more major risk with these new weekly funds in the implosion of another fund last February. Investors in the SoFi weekly dividend ETF, the ticker WKLY, woke up to hear that their fund would be shutting down and no longer traded. This is almost always because the fund couldn't attract enough investors and increase that net asset value enough to where the expense fees covered their costs. For example, I can almost guarantee you that the roughly $1.2 million in annual fees the QDTE is right now collecting off of its $128 million is not enough to cover those expenses plus salaries. That does not mean the fund is going to shut down, only that it needs to attract more investor money, and it does appear to be doing that. It is a risk, though, in these new, smaller ETFs, and when a fund does shut down, current value of your shares is returned to you, but that's going to mean tax implications, just as well as just finding a place to reinvest your money. I'm going to show you that do-it-yourself approach to weekly dividends next. But first, I've got to send that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. I've shown you how to set up your portfolio for weekly and even daily cash flow in the past, buying dividend stocks that pay out so you receive that constant cash flow. I'll compare these strategies next and help you decide which is better for you, the do-it-yourself approach versus investing in these weekly dividend ETFs. But the DIY approach is easier than you might think. With just 4 monthly dividend stocks, you can create a portfolio that pays you every single week. It works by going through your favorite monthly dividend stocks, going to the dividend history, and then just noting which weeks they typically pay. Since most dividend stocks keep an extremely consistent schedule, this usually means paying out in the same week of each month. So you go through your list and map out which weeks each one pays. Then putting them all side by side for when they pay out, you can choose a stock or an ETF to buy for each week and plan out your cash flow. In a recent video, I selected shares of the JEPQ, ARR, PFLT, and SVOL for a model portfolio and a combined 12.7% dividend yield. Now, of course, you're not just blindly buying stocks by each week they pay out or the dividend yield. You still need to analyze each to find the ones that you think can produce that higher cash flow, also the price appreciation kicker. I'm going to link to a full video in the description below for more detail on how to set this up, including that daily dividend video for that 4-stock portfolio and the 12.7% dividend. Stocks have largely traded flat over the last 3 months since, with ARR up 3.9%, the rest of them down slightly. It's a higher dividend yield than QYLD and has beaten the QDTE on that price return. I'll help you decide which strategy is better for you, those weekly dividend funds or the DIY approach next. But if you're hoping to live off your dividends, you won't want to miss a new series on the channel and this video, the 10 highest paying monthly dividend stocks. I dig deep into the free research reports on the highest yielding stocks, show you how to analyze them and how to find the best. So make sure you check that out next. I'll admit, I've been a skeptic on the QYLD covered call ETF in the past for its massive share price loss versus that NASDAQ 100 stocks. Yeah, the 12% dividend looks nice, but you could have just invested in the QQQ and made 180% more over the last 5 years. Here in this monthly dividend fund, you see the same dividend uncertainty, and the payment has come down regularly. And this weekly dividend QDTE may be just as bad on price, with it down almost 5% since inception and a loss of 15% versus the QQQ, but that dividend yield is hard to ignore. Even at its worst, the yield on the weekly fund was around 20% annualized versus 12% on the QYLD ETF, and lately, it's been paying out at upwards of 60% yields. You could try to reproduce the same daily covered call selling strategy on your own, selling those 0-day call options and collecting the dividend every day, just like our explanation earlier. That is a lot of work, though, and I'm not sure it would be any better than the results we see with this professionally managed QDTE. So for that high yield, I think that's the way to go. But if you're willing to accept a slightly lower yield, I think the do-it-yourself approach is still a great option, buying those monthly dividend stocks directly. Depending on the stocks you buy, the dividend yield can still be a very respectable 10 or 12%, and here you'll have more opportunity for price upside as well. Maybe it's just personal preference, though, and I always defer to having some more control over my own investments, so investing directly rather than a fund. It's more work and more complicated, but I save on that management expense, and it's what I enjoy anyway. If you don't want to pick your own stocks and manage the portfolio, something like that QDTE or the XDTE can get you those high weekly cash flows in exchange for maybe a little added expense. Stay ahead of the market with all the news, strategies, and trends you need to see with the Weekly Bowtie, our free weekly newsletter with the invite link below. Or click on the video to the right for the 10 highest paying dividend stocks right now. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification. Hey Bowtie Nation, Joseph Hogg here with a new series on the channel and one of the most popular themes, monthly dividend stocks. Every couple of weeks, I'll be digging into the Nareit REIT Watch report of real estate dividend stocks, as well as the Raymond James Weekly Insight report on those high-yield business development corporations, the BDCs. These two reports offer loads of information on some of the best dividend stocks around, the highest yields, and most of them monthly payers. In fact, there's almost too much information to digest, so we're going to cover just one topic each video, and this week, I'm going to show you the 10 highest yielding monthly dividend stocks in these lists. We'll work through the analysis to find the highest yields, but more importantly, the highest sustainable dividend yields. Because if you've been investing in dividends long enough, you know that sometimes those with the absolute highest dividends aren't the best stocks, especially when they cut that dividend. Let's get started. I'll show you how to find each of these reports and some of the information in them. Understand, I have no relationship with either of these two companies. I don't get a commission or a kickback if you use the reports. I follow these reports. It's some great analysis, and I want you to have the best resources when you invest. Another important resource you'll want to see is our free weekly newsletter, the Weekly.
Espérate, espérate. Simón, 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 Simón. Sin placas. Vamos a ver que no veo ni el otro. Sin placas otra vez. ¿Qué? Aquí está otro atrás, aquí está otro atrás, aquí está, aquí está. Aquí está atrás. Ahí está detrás, detrás, detrás. Súbete al carro y arróllalo. Luis atrás. Ah. Voy a agarrar las armas para dárselas ahorita. Y nomás puedo agarrar dos. No. Ok, no lo vi. Ok. Es como tú.
He's already in the place.
Hey guys, I gotta go to play some Club Series.